Hi everyone, welcome to Market Update with Team Schulze. I want to go through a few things with everybody today. First being a product highlight for our Approved to Move Plus program. Second being an overview of what interest rate markets are doing and how that might impact your buyers. And the third, going over some changes to FA's policy that impact Fannie Mae, Freddie Mac. Those are positive things for home buyers in the second home and investment property market. So our product highlight this week, Approved to Move Plus. All right, this is for buyers who are in the market looking to put offers on properties. What we're aiming to do is to take the contingencies out of their offers. So right now, your bare minimum for a buyer who's going to put an offer in is a pre-approval, right? So pre-approval is credit run. It's documentation review by myself as the loan officer. And we're saying, hey, this buyer is qualified, they meet program guidelines, we go into contract, we're going to get a commitment from our underwriter. Second level, right, for these buyers would be a credit commitment. That's our Approved to Move program. So we actually take that documentation, we submit it to our underwriter, and they give us that approval, that underwriter approval, that credit commitment before we go into contract. So a buyer can go to a listing agent, they can put their offer in, they can say, hey, I'm fully credit underwritten. We're taking it a step further with our Approved to Move Plus. What we are trying to do is guarantee the value on an offer. So when a buyer identifies a property, they go through the credit approval, they make an offer on that property, we're going to take that address, we're going to run that through our internal appraisal team, and we are going to determine a confidence level on the value for the offer. If that confidence level is high enough, we are going to guarantee the loan amount for that purchase scenario. Okay, we're going to say that we guarantee the value no matter what the appraisal comes back at. What that will allow us to do is turn that offer into a contingency-free offer, right? We are just as good as a cash offer because the file is credit underwritten and the value is guaranteed. Okay, we don't have any concerns, any risk with our buyers. So that's a home run. I don't know any other lenders on the market who are doing this. Our credit approvals are completed within 24 hours. Our value guarantees 15, 30 minutes tops. It is fast. We're not waiting. Great program. Okay. Let's jump into interest rates. What are interest rates doing? So I'm just going to pull up a chart for us to look at. What we're looking at here is the yield on the 10-year Treasury. Okay, 10-year Treasury bond. That is going to be your closest indicator to what interest rates are doing, right? As the 10-year Treasury increases, interest rates are typically increasing. As 10-year Treasury drops, interest rates are typically dropping. So what we're looking at here, this chart is going back to September 2019. We saw rates pretty fairly narrow range back in 2019. Right here, we see them drop significantly. This is the pandemic, right? This is COVID lockdowns. We saw rates drop, we saw them bounce up. A lot of volatility in the very early stages of the pandemic. They settled down at these historic lows. We got into later in 2020 election, right? We started seeing rates creep up a little bit, and then we got into vaccine news, right? And vaccine news, which occurred earlier than some projections, really drove rates up higher. They then consolidated back lower. And since early August, we have been in a very narrow range for rates, right? We would call this a consolidation range where rates move slightly higher, they move lower, slightly higher, lower. And what we were watching up until really this week was a ceiling that had formed right around 1.38, 1.39 on the 10-year Treasury yield. It had tested that 1, 2, 3, 4 times. Last week it tested it again and dropped back down. But we had a Fed meeting this week, always increases risk. Fed signaled that they might be tapering, decreasing their bond purchases a little earlier. That's not good for bond yields, and markets have broken through that ceiling. So there's some concern here. Whenever we're in a consolidation, our advice is to lock in, right? Because it gets narrower and narrower and narrower, and it's going to break one way or another. The risk has always been for it to break higher, right? Rates are at historic lows. It's more likely for them to increase. We saw that this week. So luckily, our pipeline is fully locked. This is going to have an impact on buyers who are not in contract yet or looking. Anybody who's thinking about refinancing should absolutely consider pulling the trigger right now, because this is a breakout that could continue, and we could see a couple of things here. We could see rates slowly increasing over the next couple of months, or we can see rapid increases like we saw back when vaccine news broke out, and we saw these big increases, a little bit of a pullback, big increase. So we really are in defensive mode here. We're locking. We want to make sure that we can cover the rates that we're looking at today. Okay, every rate that we quote is a 90-day lock. It has free 15 days of coverage. So every buyer that we're working with has 105 days of lock coverage. That typically is going to cover them through a standard purchase contract. So there's really no reason that we wouldn't be locking. In one of the future updates, we'll go through our float down policy. It's very aggressive. There's really low risk for buyers to be locking in at this point. There's really not much reason that you would be floating at this point, just because we've broken through some very key levels here. One of the most important is probably, I'll show you real quick, it's probably the 100-day moving average, right? So we've broken through all these moving averages, 8, 21, 50-day, and then the 100-day, which was acting as a little bit of support a couple days ago. We've broken through that at this point. So next ceiling, it's tough to say. It could be right here where we saw a pivot, right, all the way up at 1.59. That's another eighth, another quarter in interest rate. So you just want to be defensive right now. Last thing we're going to talk about is an announcement last week. It's been pretty quiet on this front. Not many people talking about it, but the FHFA announced a pause to the changes that the Trump administration made on their way out for Fannie Mae and Freddie Mac. So one of the goals of the last administration was to get Fannie Mae and Freddie Mac out of government conservatorship. One of the big things that impacted lenders and consumers was a percentage cap on the number of investment property loans, second home loans that could be delivered to Fannie Mae and Freddie Mac. So if a lender is only allowed to deliver a certain number, a certain percentage of those loans to Fannie Mae and Freddie Mac, they have to slow down that business. And what occurred was a big increase in second home and investment property rates. Some banks more than others, right? We weren't impacted too much, but we saw other lenders that had to increase those rates by a full percent, 1.5%, big increases. So those changes were suspended, right? So what does that mean for a consumer? Well, that means that the cost to buy or the cost to finance your second home or investment property has just come down pretty significantly for a lot of lenders. So that's big news there. With rates still being in this historically low range, investment property purchases, second home purchases are very attractive right now. If you have any questions, you can reach out to me anytime. Hope everybody has a great weekend. Thanks for tuning in.